Devyani and Sapphire, operators of KFC and Pizza Hut chains, are all set to merge to create India's largest QSR entity. Shareholders of Sapphire to receive 177 shares of Devyani for every 100 shares owned.
Hotels to cigarettes conglomerate ITC hit with a wave of brokerage downgrades as Centre's new cigarette tax cloud growth outlook. Stock now down to the lowest level since January 2023.
The banking pack reacting to quarterly updates. Indian Bank delivers higher than expected growth. South Indian Bank delivers an in-line show. For Punjab and Sindh, the growth comes in within the guided range. Strong show from the likes of Tamil Nadu Mercantile and Coforge-Encora Bank.
Auto leads gains on the street. TVS and Hero Moto are the top gainers as sales in December beat street estimates.
Scrutiny continues to rise over high commissions paid by insurers. The RBI, in its financial stability report, flags high commissions as one of the biggest impediments to insurance affordability. PB Fintech slips about 1%. Hello and welcome to Chartbusters, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it is the second day of a new year and we are continuing our momentum on the upside. So we have the Nifty, which is above a cool 26,200 as we speak, so up around 100 odd points. And we have the mid-cap index, which is up around 0.6% at this point in time as well. So the advanced decline ratio holding currently steadily on the advancing side at around 2:1 with 2,500 stocks advancing to around 1,200 stocks declining. ITC continues to languish at a 52-week low. So that stock is in focus on the back of the tax changes which have affected the stock negatively. So down around 3.5% for that counter. But separately, we have Devyani and Sapphire, which have really taken the headlines over today. And both those stocks are in focus on the back of the merger announcement. So Devyani as well as Sapphire, put the stocks in focus. Hi, Vinny.
Hi, Ekta. Good morning. Yes, because of that, when you look at Devyani, Sapphire, both of them in focus. ITC seeing a decline, like you mentioned. Nifty FMCG is that only sector which is trading in the red today, while Realty, Metals, Autos among the top sectoral gainer. But let's welcome on board Dharmesh Shah from ICICI Securities for a technical check on the markets as well. Dharmesh, good morning. Thank you so much for joining in as always. Today also markets 26,200, third straight day of green that we've seen at least for the Nifty. Now, what are the levels that we should keep an eye out on for Nifty as well as Nifty Bank?
So good morning, Mini. Yes, definitely. I think so. The year started on very quite positive note. I would say that yesterday also we had a flat positive closing, and today market seems to be gradually improving on the higher side towards 26,200 and holding up to these levels. I think so. The last 2 months we have been trading in this trade range of 26,200 to 25,700. We expect, I think so, the breakout should happen on the higher side and you should be looking for a target of around 26,700 in the month of December. So it's something I think so. The way the technical setup seems to be forming for Nifty 50 constituents, indicating, I think so, the way going forward, we should look a positive breakout on the higher side for a target of around 26,700 in the days to come. So by the dip should be the strategy, with strong support we expect to hold of 25,700 in the days to come. As far as Bank Nifty is concerned, yes, definitely Bank Nifty also has been facing the struggling point at near 60,000 levels. And it seems to be holding up this level well and fine. I think so we will be going forward. Bank Nifty also should be looking for a target of around 61,000 for the month of January. So it's something 59,500 to 600 remains to be the very strong support for the Bank Nifty, which we expect to hold and should be looking for a target of around 61,000 in the days to come.
Okay, and Dharmesh, which are the stocks that you're looking at individually today?
As far as stocks are concerned, yes, definitely remain to be positive for the large cap stocks at the current levels, where L&T remains to be a topic. Again, for L&T, the 6 weeks of long consolidation breakout seems to be panning out positive side, and L&T seems to be sustaining about the 4100, which was acting as a stiff resistance in the last 2 trading sessions, expecting L&T to head towards 4500 from the positional perspective, keeping a stop loss of 3800 for as far as L&T is concerned. Apart from L&T, Adani Group stocks looks too positive from the current levels, where Adani Port looks positive from the current levels. I mean, the last 1.5 years of a long consolidation breakout seems to be forming a cup and handle type pattern, and there is strong sets of volumes at the bottom of around 1440, 1450. We believe I think so Adani Port should be looked for target around 1675 from the positional perspective, keeping a stop loss of 1375.
Okay. All right, Harmesh, we're going to let it go on that note. Thanks very much for joining in and speaking with us and giving us all of your stock calls. Well, on that note, we're going to shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Neha Dave joins in from moneycontrol.com to talk about a stock that she's tracking very closely today. Neha.
Today's stock idea is HDFC Bank. The street continues to keep a close eye on the two key variables for HDFC Bank, and that is loan growth and net interest margin, both of which were impacted post the merger. Following the merger, HDFC Bank's credit to deposit ratio reached a high of 110% as of December 23. It has improved since then and stood at 98% as of September 25. Management had earlier guided to bring down the CD ratio to below 90% by FY27, but reaffirmed that it will not be a linear progression. Most importantly, management has guided loan growth in line with the industry growth for FY26 and surpassing the industry growth from FY27 onwards. Bank's net interest margin stood at 3.3% in Q2 FY26, significantly lower than the pre-merger level of above 4%. On the margin front, certain tailwinds are emerging, though the impact of the same will materialize over the next 4 to 6 quarters. Overall, higher advances growth, better margins, and stable asset quality are likely to drive healthy earnings growth for FY27, paving the way for the potential re-rating of the stock. In terms of valuation, the stock is currently trading at around 2 times core book value estimated for FY27 after adjusting the valuation of subsidiaries. The valuation is reasonable given that return on asset is 1.9% and return on equity is 14% in Q2 FY26 despite the focus of the bank on the consolidation of the balance sheet. Long-term investors should accumulate this stock.
Okay, thank you so much for that. But on that note, we're going to slip into a very short break. After the break, we have the management of Zaggle Prepaid, and they will be talking to us about the new tie-up with Visa to launch and promote prepaid cards. Stay tuned in for that conversation.
Welcome back. Well, for the markets, it's trading in the green as we speak, but a lot of stocks which are trending today. So Anand Raj is showing a good amount of high volume traction in today's trading session. So Anand Raj should come up for you. We have Ashok Leyland also, which is at the best levels that we've seen in around a year. So Ashok Leyland should also come up for you. So up around 1% for that particular counter. And AU Small Finance Bank as well. So that stock should come up for you. Federal Bank also, which is at a fresh 52-week high. So some amount of traction coming into these specific stocks, along with IDFC First Bank, which is also at a fresh 52-week high. So specific stocks are seeing some amount of traction in today's trading session. But Zaggle Prepaid has tied up with Visa for a 7-year partnership where it will be incentivized to launch and promote co-branded domestic prepaid cards. Avinash Godkinde, who's the MD and the CEO, joins in from Zaggle to discuss this. And there are 3 talking points that we will be focusing on: the accruals to business from the partnership with Visa, updates on achieving the growth guidance, and if any acquisitions are on the cards or not. Avinash, thank you very much for joining in. Well, let's start with this partnership that you have with Visa. Can you just explain the contours to us and what would it mean from a P&L perspective?
Yeah, good morning and Happy New Year to all your viewers and to all of you at CNBC-18. I think it's a great start for us, Visa partnership. Visa has been a partner with us for long, and we've had this, 7-year partnership now for launching and, promoting co-branded prepaid cards. Basically, these are additional spend incentives that we get. We get a small sign-in bonus as well, which is small in the overall context of our revenues, but it's sizable. And we get, spend-linked incentives, which really helps us push our bottom line over the years for the spends that we are in any case generating. So there's no additional effort or no additional expense that we incur. It's just that it's our way of sealing the partnership with Visa and making sure that there's enough volumes coming in for Visa on their network as well.
Hi, Avinash. Good morning. This is Vinny joining in the conversation as well. Could you just highlight some bit of the numbers as well? When will we start seeing the synergies? What sort of revenue will this generate? And also talk to us about the EU Small Finance Bank tie-up as well. Any numbers on terms of the progress over there as well?
Good morning, Vinny. Good morning. Yes, I think it's a great partnership, the EU one, where we're doing three different things: the retail card, the corporate credit card, as well as the prepaid card. Right. So that's going to be the first bank where we are doing all three products. Yes Bank is the second one where we are doing all three through the acquisition of Rio Money, which is now renamed as ZAG. Right. So those are the things which we are doing with AU, and we are yet to go live with the product. It's sort of a closed loop testing that we are doing right now. And we should see that kick off in the coming quarter, and there I think that would be a big one for us because we are also working with AU to overall deepen penetration for AU in different regions, starting with the South. Coming to the Visa partnership, look, this is additional basis points of incentive that comes in, Vinny. It's part of our program fees, and that's why we call our program fees and not interchange income, because interchange income is what comes to us from the banks, and that gets augmented with the payout that Visa, MasterCard, these networks do. So it's going to be a very healthy addition to our bottom line.
Okay. So you've spoken about two partnerships. Avinash, what are we expecting in terms of further partnerships that you are planning for the coming year?
Yeah, so there are quite a few in the works with banks for our retail card business. You'll hear from us on that in the coming quarters. There's a good amount of momentum now where we are going to specific banks, public sector, as well as private banks, with a very clear focus on how does it add to our revenues and our bottom lines, right? And of course, what does it mean for the banks? So today, with 19 bank partners already, we can be very, clear as to what we are looking in terms of objectives, and banks appreciate that. They like the fact that we know what we want and we know what we can give them. So those are partnerships that you'll hear from us in the coming quarters. Some could close this quarter, and some in the coming quarters.
Okay.
Right. Waiting for more announcements there as well in terms of more partnerships that will come in Q4. Avinash, but could you highlight in terms of your growth guidance, right? That's at 40-45%, I believe, is your growth guidance that you all had given. First two quarters, you managed to do well. First quarter was around 31-32%. Second quarter, 40%. Q3 is over. Has that continued? And could we expect you to achieve the growth guidance for FY26 end?
Yeah, FY26 guidance, we are absolutely on track, Winnie. Q3, Q4, we have seasonality in our business, so are always, skewed 60-40 in terms of overall revenue contributions. And we had actually originally announced 35-40% as our guidance, which we upped to 40-45%. Please note that this is all organic. Acquisitions like Green Edge and others will also contribute both to the bottom line and top line very nicely. So this is overall looking to be a very strong, picture for us in terms of the numbers, both bottom line and top line.
Okay, all right. You're confident in terms of the numbers this time, but Q3, Q4 is seasonally strong for Propel as well. Can you just tell us what the trend is looking like there?
Yeah, it's across board. Propel is obviously the festive season kicks in Q2, Q2 end, Q3 beginning. So we see an uptake there, and JFM is always a quarter where brands like corporates try to push for their sales, right? So Propel is all about channel incentives, and channel incentives obviously are high in the last quarter because they need to meet their targets. So the growth in Propel is also very strong.
Okay. Just wanted to end this conversation by asking you about your inorganic growth plans, because you have sufficient capital on your books right now. You are talking about partnerships. But what are you doing on the inorganic front? Anything that you'd be interested in? If you could just slice down what your interest would be and the size that you would be also looking at if that's the case.
Yeah, so what we are doing is twofold. We are closing the acquisitions that we have historically announced. So Rio.Money, Green Edge, a lot of these got closed. We are working on closing a couple of others as well. And in addition, there are, new conversations that are happening. We're looking for one sizable deal, which would be bigger than all the deals that we've done so far, right? And those are ongoing discussions at a fairly advanced stage. But beyond that, wouldn't be able to give more details as to what space and what is the opportunity there. But those conversations are going very well.
Okay. And Avinash, just one thing, will you be able to achieve 11% EBITDA margins in Q3, Q4? Is that on the cards given ESOP cost is reducing?
Winnie, you're putting me on the spot there. We have given a guidance of 10 to 11%. We will achieve our guidance. Hopefully, we'll be doing better than the last quarters. But we will stay in our 10 to 11% band.
Okay, 10 to 11% guidance. Avinash, thank you so much for joining us this morning and speaking with us about the new tie-ups and what we can expect from the company going forward. On that note, we're going to step into a very short break. After the break, we'll get you more on markets, more stock-specific action. Don't go anywhere. Welcome back to Chartbusters on CNBC-TV18. As of now, the Nifty is holding on to 26,250 levels, up almost more than 100 points in the trading session as of now. But let's shift focus and talk about Coforge, the big deal which closed out in 2025. Coforge's acquisition of Encora, a Silicon Valley-based AI-native software engineering firm, in a massive deal which was valued at around $2.35 billion. This marked the largest overseas acquisition by an Indian mid-tier IT company. Earlier on in the day, we spoke to Sudhir Singh, the CEO of Coforge, as well as Shweta Jalan, managing partner of Advent International, on the same. Listen in.
This is an asset that we very firmly believe offers the value, offers the synergy. I would have been happier to pay less, but in this case, we don't believe we overpaid by even a cent. From our vantage, we've looked at just about anything that's been out there in the market over the last 2 or 3 years. When it comes to capability, when it comes to looking at an asset that was born in the Silicon Valley, which is where Encora was born, when we look at the capabilities, not just of Encora, but of the merged organizations, when we reflect on the fact that the two organizations will have a $2 billion data, cloud, and AI core, we think we're creating an asset that's, as I said earlier, it's not just a 2 or 3 year fantastic growth runway ahead of us. It's a multi-year runway. We look at ROCE. We remain committed long-term to making sure that the ROCE keeps climbing up from where we are today. But we look equally importantly at the total shareholder return. This is a growth firm. TSR is as important, if not more important, at the current stage of our growth journey. When you look back at our growth journey, again, and I say this, I suspect for the third time, a firm where the valuation has gone up almost 20 times over 8 years is an extraordinary story. TSR remains a primary area of focus for us. ROE is also an extremely important area of focus for us. It will come back to where it was over a period of time.
We are not a mutual fund, right? So, I mean, the idea is not to be a completely passive investor, but, our underlying philosophy is to back strong management teams. Yeah. When you back someone like Sudhir, who's almost like an entrepreneur CEO, I honestly don't think that, we need to be, either hovering or interfering the business on a day-to-day basis. Yeah. But hopefully, if we have a role to play and a positive impact that we can make on the business, we'll certainly, both as an individual, but more as an institution, support the organization, till such time we are shareholders. I would say, from our standpoint, first of all, this is not an exit. I think that's the most important thing that you need to remember. Why have we done this transaction? Sudhir very, articulated the whole synergy piece very well, right? We think these are extremely complementary assets, which once you put, very classically 1 + 1, we think it should be maybe a 3, 4, or 5, right? So why would we otherwise not have taken cash and done the deal? We've we've taken stock as opposed to cash because we feel there's a genuine long-term value creation plan here. And that's what we expect Sudhir, who's done a fantastic job with Coforge to deliver for us or from a combined entity basis as well. So I would say for us, this is really thinking about the value creation from here on, as opposed to think when I can just jump out of the boat and sell.
Okay, thinking about value creation, that's the word coming in from Advin Shweta Jalan there. But let's move forward and talk about the big story that we've been tracking since last evening. Mangalam joins in to tell us about the Sapphire-Devyani merger and what this would mean for the quick service restaurant industry in India. Mangalam.
Well, the long-pending merger of Yum brand franchises has finally taken place, where Sapphire board has agreed to amalgamate into Devyani, and this is a deal which is clearly positive Devyani and positive industry or the combined entity as well. The reason why Sapphire is lower and Devyani is higher is one, that the street was expecting the ratio to be in favor of Sapphire. Instead, it was done at an at par, no arbitrage sort of current market price valuation. And the second part is that Devyani is also going to acquire 19 KFC outlets, which are currently operated by Yum, which gives them complete ownership of all the Yum brand franchises in the country. The deal is valued at current market price, so accretive valuation for Devyani, revenue and cost synergies on removal of overlaps, benefits of scale and operating leverage continue as well. If you look at the pro forma numbers as well, Devyani's current store count is 2,039, Sapphire is about 963. Together they will have over 3,000 restaurants, and together they will have revenues of almost 7,800 crores versus Devyani of 4,950 crores right now, operating EBITDA of 500 crores and margins at around 10% as well. So all in all, from a shareholder standpoint, Devyani's business post-deal, the revenue increases by 58%, EBITDA increases by 53%, for which they have to, pair just 46% equity base or dilute that. So on many parameters, this is positive Devyani, and as a result of which that stock is higher. Near-term weakness for Sapphire because of the disappointment when it comes to swap ratio. But importantly, now that the swap ratio is out in the open, both these stocks will move in tandem.
Okay, Mangalam, thank you so much for that, keeping an eye out on Devyani as well as Sapphire through the day as well. But with that, it's a wrap on this edition of Chartbusters on CNBC TV 18. Thank you so much for tuning in. Up next, your trading hour.